Here are the STC Crunch Time Facts for the Series 65, Chapter 11! We ran out of fingers. Maybe I can go like this. Alright. Cash dividends are taxable in which the year they're received, whereas stock dividends and stock splits don't trigger a taxable event until the stock is sold. Preemptive rights are offered to current shareholders, which give the shareholder the ability to maintain proportionate ownership in the company. So these are basically anti-dilution rights. So if people buy more shares, then your percentage in the company won't be pushed too far down. Warrants are issued in connection with another security and as a unit and provide investors an added incentive to purchase the subject security. The spot market, not to be confused with stock market, the spot market is for trading foreign currencies directly. An ADR, American Depositary Receipt, is a stock-like security that lets U.S. investors buy shares of foreign company in U.S. dollars on U.S. exchanges. ADRs represent shares of stock in foreign companies. Okay, we just went over that one. Foreign currencies trade in the spot market, and a currency's price is referred to as the spot rate. Market makers are not required to maintain an absolute inventory of shares. A stop order becomes a market order once it's activated. A stop limit order becomes a limit order once it's activated. And what's the difference? A stop order is when a price hits a number, it sells no matter what the price is after, whereas a stop limit order, when the price hits a number, it only sells if it can get that price or better. The break even for a client who's long, so they have those shares and they're waiting till the price goes up, who's long 100 shares of a company at $60 and buys that same company's shares for 55 put at 3 is 66 per share. So what does that actually mean? It means the cost of the stock plus the cost of the option is the price per share. So $60 of that initial purchase, like $60 a share, plus $3 for the put. All you gotta do is add it together. It's just like, it sounds a little complicated, but you got it. An option's intrinsic value is the amount by which it's in the money. So this is kind of like alpha, or kind of like alpha being how much excess you beat the market by. This is kind of like how much more gain you get from the option. So basically you have to buy the option, and then if you make money from it, you have to subtract what you make from how much the initial was. So the call option is in the money if the stock price is above strike price. So with a call option, let's just say I'm an investor, I'm going to buy a call option, and that gives me the right, but not the obligation, to buy a stock at a certain price, like maybe $50, and let's just say the stock goes to $60, and I can buy it for $50, then that's a great deal for me. So that's in the money, because the stock price is above the strike price. But put option is in the money if the stock price is below the strike price. So I'm an investor and I buy a put option that gives me the right to sell a stock, so I can sell it for $50. So let's just say the stock price goes down to $40 and I can sell it for $50. That is in the money. A UIT is not a derivative. So that's a unit investment trust, and then a derivative derives its value from something else, so it's not doing that. A swap is a private contract between two parties to exchange cash flows or financial instruments, like interest payments, currencies, or commodities, based on set terms. It's often used to manage risk, like interest rate or currency risk. And it's a customizable derivative that can be used to hedge against risk. However, it increases an investor's overall cost. A swap is a form of a derivative whereby two parties agree to exchange fixed rates for floating interest rate-based cash flows. So that's kind of what we just said. A credit default swap is a type of credit derivative which provides a fixed income investor, usually an institution, with insurance if the issuer defaults. The risk is shifted from the insurance company to the other CDS, credit default swap seller, in exchange for a fee or premium. If the underlying issuer defaults, the bondholder receives payment from the seller. A short stock position can be protected with a long call, so you're hedging against your losses. And then a long stock position can be protected, hedged, with a long put. Precious metals include gold, silver, platinum, and palladium. I haven't even heard of that one, palladium, but not copper. Soft commodities are grown while hard commodities are mined or extracted. So you could think of Minecraft, like the soft commodities would be like the apples or wood for your house, but the hard commodities, you gotta go, they're harder to get because you gotta go to the mines and maybe fight like a creeper or skeleton. So those would be like diamonds, in Minecraft at least, or emeralds. I actually don't know if they still have they have diamonds. I don't know if they have emeralds, the green. Anyway, you get the point. Both the buyer and the seller of future contracts have obligations. So unlike an option, you don't have options, you have an obligation to buy or sell. All right, 2 more. A short straddle is created by writing a call and a put on the same stock with the same expiration and the same strike price. For a short straddle, the investor expects stability. So it's called that because you're buying both the call and the put, so you're straddling it. If a client expects volatility in a stock but is unsure of which direction the stock may move, they may buy a straddle. For a long straddle, the investor expects volatility. Alright, that's it for 11. Hope this helps.